The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And our Sunday best to you on this unseasonably warm weekend. Welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettler, along with Accunet Mortgage and Realty Advisors, owner and president Brian Wickert, and licensed millennial loan consultant David Wickert. As you probably know, if you have a question, you can give us a call at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620. So we got some interesting numbers in when it comes to the fastest appreciating metro areas.
You bet, and I think today's a great day, by the way, with weather like this, and I'm sure yesterday was too, to get out there and shop for some homes, write some offers.
Drive around,
see what's up. Yeah, absolutely. Open houses are probably going to have good attendance today. And so I was looking around the interweb and came across an article about the 10 fastest appreciating markets in 2016, and this was according to Atom, that's spelled A-T-T-O-M, Atom Data Solutions, which calls themselves the, quote, curator of the Atom Data Warehouse, a fused multi-source national property database.
Sounds fancy.
Yeah, fused. I think they got to heat it up to a high temperature to get the fusing to happen. And I picked up the data from the National Mortgage News. All right. So number 10, the 10th fastest appreciating market in Milwaukee in 2016 is Nashville, Tennessee, where the median price is $203,000, and they experienced a 9.7% increase in the median price.
Nice.
Okay.
That's a lot. It's like $20,000.
Sure.
Okay, number 9, Pensacola, Florida. Home of the Blue Angels, by the way, which we visited one time. I love the Blue Angels. Okay. That's where their base is. $150,000 median price, an 11.1% increase. Now I want you to start to pay attention to the states that I mentioned.
Yes.
Number 8, Kennewick and Richland, Washington. The state of Washington, $205,000 median price, 11.2 increase. And I asked David, where is Kennewick, Washington?
3 hours southeast of Seattle.
Near?
Walla Walla.
Because how often do you get to say Walla Walla, Washington on your radio show?
Yeah.
Right down there. Okay, number 7, Fort Collins, Colorado, $310,000 and 11.3 increase in price. Tied essentially with Denver, which also saw an 11.3% increase and a little higher price, $330,000 for the median. Number 5, Honolulu, Hawaii, $515,000 median price.
They don't have a lot of,
not a
land.
lot of space to expand there. Yeah, go up into the volcano. 12% increase. Portland, Oregon, $315,000 median, 12.1% increase in price. Salem, Oregon is in number 3 spot, $214,000, 12.7% price increase. Boulder, Colorado, $443,000 at 13.3%. And the number 1 surprised the heck out of me. I would have never guessed this in a million years. Myrtle Beach and North Myrtle Beach, South Carolina, where the median price is only $189,950. But that was a 23% increase over last year. All right.
Well, when you have beach in the name of your town,
that probably
things are going in your favor.
But I was surprised at how reasonably priced it was. All right, so now for the 5-county Milwaukee metro area, David.
I'm just observing. You said all West Coast cities and then Denver.
Right. Okay.
Colorado.
So here, out of those top 10, I just want to point out that 60% of the top 10 were either in Colorado or Washington. And what do they have in common? Legalized marijuana.
Okay.
That's my theory, is that home prices right now are tied to weed. Okay. So 5-county Milwaukee metro area last year, that price increased up to $199,900.
Okay.
$199,900 was the median home price according to the Greater Milwaukee Association.
Average.
The median, right? And David, go ahead and explain the difference.
Well, it's just what was the one in the middle out of 101? What was the 50th home?
Half were above and half were below the $199,900 mark in Milwaukee. I mean, so if you think about all those numbers I mentioned, we're right in there with a lot of those markets. It's not like we're a cheap market. And that was according to the GMAR, of which I'm a member, Greater Milwaukee Association of Realtors, multiple listing service. That median price is up 5.2%. So not bad.
Compared to last year?
Compared to 2015, yeah. It was 190, and
that's
now we're up to
$10,000.
Exactly. That's not chump change. So we're not like on fire like those other ones, but very respectable, I think. All right, now when we come back from this first break, I want to take a look at the other side of that equation, which is how affordable is the Milwaukee market. And to do that, you not only look at the median home price, but also the median income. And I want you guys to think about what you think the median income is in the Milwaukee Metro Area. Do you think it's $44,000? Do you think it's $49,900 as the median income, or do you think it's $56,000? When we come back, we'll give you the answer and translate that into affordability.
Right here on the Accunet Mortgage and Realty Hour on 620 WTMJ.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, it's been 6 months since the violent protest rocked the Sherman Park neighborhood. How's that area fully recovered from the unrest? You can hear from a local leader in that neighborhood during Wisconsin's afternoon news coming up at 3:20 this Monday afternoon. Brian Wickert is with us. David Wickert is with us here on the Accunet Mortgage and Realty Hour.
And we're talking affordability. How affordable is the Milwaukee metropolitan housing market? And that question can only be answered in the context of income. So I'm sure you guys went out and Googled the answer to my question, which is, what is the median household income according to the United States Census? So I'm not talking about individual human being. This is a household of people. And I will give you a clue. The United States average, median household income, thank you, is $55,775. That's the median for 2015. Do you think, Steve, you can go first. Do you want to pick $44,000 for the Milwaukee area, $49,900, or $56,000?
$49,900.
$49,900, Dave?
I'm taking 44.
Okay, 44, and the answer is $56,247.
Wow.
So let's pat ourselves on the back, Milwaukeeans,
Yes.
Household people, because we're above average, just like Lake Wobegon. And the Wisconsin average, we're also better than that, is $55,638. By the way, I find this hard to believe. The one-year change, this is again according to this census, is 5.68%. So up 5.68%.
People are making $2,500 more dollars?
Yeah, per household, according to the census. Now, just one other little tidbit before we turn that into housing information. Household income peaked in the Milwaukee area at $58,000 back in 2007. So we're still a touch below that. And then it fell as low as $53,000 back.
Is that adjusted for inflation?
I don't know.
Okay.
That's classified.
Okay.
I'll
what does that mean for a housing payment then?
All right. Well, I'm glad you brought that up, David, because let's translate that into how much house can I afford? Because we get asked that all day, every day, by great people. That's what we do. When you click on the blue button, we're in the business of telling you how much house you can afford. And the key metric is the debt-to-income ratio.
I call that the affordability calculation, the budget calculation we got to do.
I call it your financial blood pressure.
Okay.
So the debt-to-income ratio is real simple. You add up your house payment, principal, interest, taxes, and insurance, including mortgage insurance if you're going to need to pay that, plus your car payment, your student loan payments, and your minimum credit card payments. You add that all up, and it's what percent of that of your income can you devote to paying those monthly bills. Keep in mind, lenders, amazingly, would get to use your gross income.
And we're not counting your cell phone bill, your cable bill, your
utilities
heat bill.
Right. That's out of the calculation. So I just think we're using the number before any income tax or health insurance is taken out of your paycheck. All right, so you got that all in mind. The ancient rule, when I first got started in the business back in 1985 at MGIC, the brochures we printed and our guidelines were 36%. You can't spend more than 36% of your income on all your monthly debts. Then that soon got stretched to 38%, and effective January 10th, 2014, the federal government actually came out, published a regulation that said it's not safe to lend anybody, make anybody a loan where more than 43% of their gross income was devoted to their monthly obligations. All right. So if you use the 43% number on the Milwaukee median, the most you can devote to your monthly payment of everything is $2,015 a month. All right, so when we come back from this next break, we'll do the big reveal. Does that mean that you could buy the median priced house in Milwaukee based on your median income?
It depends, right?
Well, we'll tell you the real answer when we come back.
And if you have a question for Brian or David, you can reach us at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And David Wickert as well. Two men who understand Milwaukee's growing startup scene share their perspectives. You can hear from Matt Cordio and Ben Stanley of Biz Times Milwaukee on our latest Tech Wisconsin podcast from the WTMJ mobile app. Brian Wickert is with us. David Wickert is with us as well.
We're talking about affordability in the Milwaukee Metro Area in particular. And it's something we do every day. You know, how much house can I afford? And I want to give a tease for after the news. We're going to talk about the future of the mortgage industry because there is a real chance that mortgages over the next couple of years are going to get less affordable as the federal government tries to withdraw itself from a frontline seat. What do you have to say?
I was just going to say they're going to look different. But, okay, go on.
I'm talking higher rates.
Okay.
Stuff like that. Okay, but for right now, the answer is, as David pointed out, can the person making the median income of $56,247 in Milwaukee afford the median priced house that came in last year at $199,900? I'm going to round to $200,000. Okay. What are the two things, either one of you can jump in on this, David, that will affect the answer to this question? What are the two big other, it's not just the income, it's not just the property price, and I'm going to put out there, 5% down payment. So let's get that out of the way because that would be one factor. What else, David?
It's going to be the property tax bill.
Okay, property tax bill. And do you want to jump in with any other guests there for the other
Sure, credit score.
Credit score is absolutely one.
There you go.
And then, so I'm going to assume for the purposes of my math that they have good credit, 740 or higher. The other thing is how much other monthly debt do you have? Because I just blurted out before the last break, hey, you can have up to $2,100 of payments, which include your car, your credit cards, your student loans. And so I'm going to use a hypothetical family that has $500 worth of those, right? Credit cards, cars, student loans. So now we knock that off our $2,100 total number, which backs us into what's your maximum home payment. All right, so that's just what we do every day. And so that would be $1,600. Well, if you bought a $200,000 house in a municipality in an area where the property taxes were only $3,000, your monthly payment, including principal, interest, taxes, and insurance, would only be $1,314. Your debt-to-income ratio, remember I said the maximum is 43% normally, it would only be 39%. If you went and bought in a municipality where the taxes were $4,000 a year, so instead of $3,000, same house, but the property taxes are higher, now your payment's just going to be a skosh under $1,400. Your debt-to-income ratio is 40%. And then if you bought in a place where the property taxes were $6,000, meaning that's roughly 3% of the purchase price, which is most of Milwaukee County. So if you buy in the city of Milwaukee and a lot of other places, then your house payment's just going to be under $1,600 a month. It's going to be $1,564. And so your debt-to-income ratio there on the median income with the $500 would be 44%, which we could still get approved using Fannie Mae and Freddie Mac's underwriting system.
But that is tight.
That is right at the edge. Because 45%, is
pre-tax, by the way.
Pre-tax.
Now, you got to have something left over for, beer and groceries.
Right. It's groceries is not included in that. Gasoline to get to work is not included. As you pointed out, utilities, cable bill, all that kind of stuff.
I call that the property tax monster because it can eat into, if your maximum payment is that $1,600 and you're buying a
house with
home with higher property taxes, it means you can't apply more of that payment to the house itself.
To the loan balance,
Correct.
which translates into purchasing power.
House, yeah.
So it doesn't take long for home shoppers to figure that out. But you know what? On our cool mobile app, which you can download by clicking on the green button, not the blue button, click on the green button on your mobile device right at Accunet.com. You can get our cool mobile app, and then you can use it to calculate your principal, interest, taxes, and insurance.
Well, because if you're walking in a house this afternoon,
Yep.
the question you're going to ask each other or your agent is, I wonder what the monthly payment would be if we wrote an offer on this place.
Exactly.
That's the question.
And the super cool thing about our app is it does include the cost of monthly mortgage insurance based on your credit score. So if you know what your credit score is, you're going to get an accurate principal, interest, taxes, and insurance. And if you're looking at a condo, you can also plug in the homeowners association dues. We didn't talk about that. That's part of the debt-to-income calculation, and that is something we have to include for people that are looking at condos, because we have to include that homeowners association.
Well, it's a real cost.
Well, you know, funny enough, just a quick word on that, it's just putting into a monthly payment the cost of maintaining the building.
Yeah.
You have similar costs on your single-family home.
You're just not socking away for your own roof in your single-family.
Right. And so really, if we were really good at this whole risk management thing in mortgage lending, we would probably assess some deferred maintenance costs on people who are buying single-family homes. All right. When we come back after the news, we are going to talk about the future of mortgage lending in America, because the federal government's participation in that is back on the chopping block. It's a live issue once again, and we're going to give you the details on that when we come back after the news.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ. It's now 10:30 as we welcome in from the WTMJ 24-hour newsroom, Colleen Boland.
Thank you, Steve.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert is with us. David Wickert is with us. If you have a question, you can reach us at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620.
Hey, so, the federal government is up to its neck in the mortgage industry, and in the following ways. You and I, as the federal government, seized basically Fannie Mae and Freddie Mac back in 2008 during the housing crisis, and so now we get all the profits from them and all the risk. By the way, the other ways that the federal government participates in the housing market, FHA, those are actually government-insured mortgages, where we, as the federal government, collect premiums from borrowers and pay out claims. And David, didn't you just tell me that the delinquency rate on FHA loans is up?
It's up to 9%, which means you're at least 30 days late.
Nice.
So,
okay. So that's supposed to be self-funded, but let's set that aside for a second.
That's almost 1 out of every 10 FHA loan. But
yeah, wow, you're good at math.
Math.
Then the other type of federally guaranteed loan is VA, and that's not going to get touched, in my opinion. And then the last one is really small, is United States Department of Agriculture. That's rural places, again, really small. So we want to talk about Fannie Mae and Freddie Mac. Why? Because that is the big chunk of the mortgage market. That's how we get 30-year fixed-rate loans in America. And so it became apparent back in 2008 that these two private companies, you could buy stock. I worked at Fannie Mae. I owned stock in Fannie Mae at one time. Privately held, it was clear that they were going to go bankrupt. Why? Because they were, at the same time, both the world's largest private mortgage insurance companies, meaning they were guaranteeing investors who bought mortgages that Fannie Mae will make up for any foreclosure losses. Don't you worry. I will take care of it. Why? Because I'm collecting fees from the borrowers, and I'm collecting enough. Oops, I'm not collecting enough based on all the loans that were blowing up. All right, so the U.S. Treasury, all of us listening to this radio show, we pumped into these two private companies $187 billion with a B dollars.
That's 9 zeros.
That's a lot of zeros to pay for all the foreclosure losses so that the State Teachers Pension Fund of Wisconsin or Oslo, Norway, or whatever sovereign debt fund, they didn't lose any money. All right, so we wrote the check. Guess how much? Do you think we've paid back all that? Do you think Fannie Mae and Freddie Mac have paid back all that money yet, Steve?
Yes.
Yes.
That and then some.
Yes, the answer is yes. Fannie Mae just reported they earned $12.1 billion last year alone, and together with Freddie Mac, they have paid back, are you ready, $256 billion. So we're in the black by like $69 billion. We are like making bank on Fannie and Freddie. Yet the Obama administration and now the Trump administration have both come out and said we have got to shrink our role because right now you and I as taxpayers, we are on the front lines of Fannie Mae and Freddie Mac. If there's another big dip in the economy and they start losing money again, we are writing checks again. Okay, because we're not allowing them to keep any fudge factor capital in there. And so the Senate banking chairman, whose real name is, I'm not making this up, Senator Crapo from Idaho, he has come out and said, yep, it's back on the docket. We are going to take a serious look at housing reform. So when you hear everybody in the news that the Senate or the House are looking at housing reform, what they're talking about is shrinking the federal government's role in guaranteeing mortgages. Guess what that is going to do? Oh, by the way, and the new Treasury Secretary, how do you say his name, David?
Munchin?
I
think so.
He is in favor of reducing the government's role and bringing in private capital, meaning...
Janet Yellen said that this week, too.
She said it in her Senate banking and House banking. Yeah, okay. Let's bring in private capital. Well,
who's private capital? But okay.
Well, like the mortgage insurance companies or Wall Street, because private mortgage insurance companies like Milwaukee's own MGIC, they're guaranteeing against foreclosure, but only on loans that have less than 20% down payment. So the talk is let's bring in private capital to guarantee loans from foreclosure loss where the people have more than 20% down payment. Right now, Fannie Mae is collecting the equivalent to about 0.5% of interest on every loan that we do in order to guarantee against that loss. And then if you have less than 20% down, MGIC and other PMI companies are putting other guarantee on it. So you had a figure from a couple of weeks ago that by getting private capital in, to substitute for the government's role, that's going to jack up rates by at least 1.5%, if that actually happens.
Right, because your backstop is not Uncle Sam anymore.
Right, who's kind of got like, we don't really care.
Full faith and credit,
Right.
Taxing power.
So that's going to be a big impact, and that means the new speech we got to start giving everybody, starting right now at this minute on the show, is buy as much home as you can afford now. That's what this means for home shoppers. Don't buy the 2-bedroom starter thinking that, in 5 years, the world will be the same, because it may be materially different. It might be a lot more costly to borrow money 5 years from now after housing reform than it is right now. So buy that 3-bedroom home and, that you could live in for the rest of your life or whatever the case may be. Stretch a little bit now. Rates are not likely going to be lower in the future. Buy as much a house as you can reasonably afford today. Anything to add to that, David?
No, that's it. When we come back from this break, I'll do a quick rate roundup and some stories from the front lines of mortgage and real estate when we come back.
Here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Important home buying questions and answers you can count on. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
From the Marcus Center to the Milwaukee Symphony Orchestra, Milwaukee is home to a thriving arts community, but does the city need to maintain its cultural assets a little bit more? Artistic Director of the Milwaukee Ballet, Michael Pink, discusses that and much more during our WTMJ Conversation Show, which is coming up at 11:07 this morning. You're listening to the Accunet Mortgage and Realty Show with Brian Wickert and David Wickert. We're up to the rate roundup portion of the show.
All right, so at the close of business on Friday afternoon, Accunet could deliver a 30-year fixed-rate mortgage still at the glorious 3.99%. It would, however, cost 0.4 of a point to get there, so your APR would be 4.051, and that's $1,900 in closing costs.
What if I didn't want to pay that much, dude? In closing costs?
Well, then 4.125% would just be $700 in closing costs. APR is 4.15.
All right.
So, but and what I point out, I think a lot of lenders have been advertising the equity builder.
No, that's me. That I had the equity builder.
Okay, then someone's copying you because I've heard it a couple times.
Oh,
but you could do the 20-year fix. At 3.99% with no closing costs, and the APR is the same, and the difference in the payments $257 a month, and it's just a forced savings
It
plan.
is. It's a forced savings plan. Okay.
So, also, if you're looking to really get at it at the 15-year, Accunet could deliver 3.375%, which is a regular closing cost of $1,100. The APR is 3.419. To your point on Fannie and Freddie, or the federal government getting out of mortgage lend, FHA rates are lower than this as well. And it is interesting. Janet Yellen testified in front of Congress this week and gave every indication that they are still on the warpath to raise rates at least 3 times. Shoot, they might even do it here in March.
That's what she wanted to make the point was, hey, we might just do the first rate increase because, if we're going to do 3, they don't meet every month.
Though the markets only think there's a 17% chance that they'll raise rates.
She's trying to make it look like it's a lot higher. And that meeting, by the way, concludes on the famous Shakespearean date of the Ides of March. March 15th, for those of you who don't have your Ides Latin dictionary out there.
But the interesting thing is that if the federal government rolls back its involvement in Fannie and Freddie, all it really means is more loans are going to be FHA flavored.
Could be.
Which is it's taking from one but then getting in deeper with the other. That's like, we're not as much in the mortgage business except we're going to do more FHA loans, maybe.
That's an interesting point. Just by the way, on an FHA loan, while you were doing the regular 25% equity and all the other right stuff, with just 5% equity and a credit score as low as 620, Accunet Mortgage could deliver a 3.875 rate on an FHA 30-year fixed-rate loan.
Yeah, but what's
the annual percentage rate is 4.87, and that's because on an FHA loan you get to pay monthly government mortgage insurance. That is the equivalent of 0.8%, so a little less than a point.
And just as a friendly reminder for folks, when you're out there shopping for your mortgage, because you just got a house under contract on this beautiful Sunday afternoon, the APR is the government's attempt to show the real cost of the loan over the life of the loan.
Entire life of the loan, 30 years. Nobody keeps their loan for 30 years, but it includes the cost of monthly mortgage insurance and certain fees paid up front, like points. Remember, 1 point is 1% of your loan balance.
Yes.
So if you're borrowing $200,000 and you're paying a point, that's $2,000 of interest paid in advance, which under the APR calculation, in my opinion, it slathers it out too thinly because you're just taking that and you're spreading it out over the whole 30 years. What we do for people when we're giving them rate and closing cost options is we give them a break-even analysis, meaning how long, if you pay an extra $2,000 in closing costs, how long will it take you to make that back?
When does it become worth it?
When does it become worth it? So we try to do a little bit better job than the government's APR, but a good thing to keep in mind when you're comparing FHA versus other alternatives.
All right, when we come back from this next break, a couple stories from the front lines of mortgage lending from this past week when we come back.
On the Accunet Mortgage and Realty Show on 620 WTMJ.
Don't just find a house, find your home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickard is with us. David Wickert is with us on this beautiful start to a Sunday morning. Great weekend to go out and maybe look at houses on the open houses that are out there today. And David Wickard joining us with stories from the front lines of mortgage lending at this point.
He's going to let me tell my story first. On Thursday afternoon, I talked with a father and daughter. And the daughter is going to go out there and shop for a condo in...
I got to listen to your conversation.
You did.
You love those.
I love that.
You lay in. Not lay in, that's the wrong. You become Professor Wickert.
I can't help it. But that is always the greatest honor, is when a customer or friend entrusts their child's home purchase to us as mortgage professionals, and we're love doing that. Okay. So she's fortunate. She's going to have a big down payment, and she's looking for a condo on the east side of Milwaukee, or maybe the Fifth Ward, something like that.
Hip cat.
So now check this out. She's going to make a big down payment, and so I ran a number here where she was going to borrow $110,000. She's got $120,000 to put down, so not your typical first-time buyer.
Whoa.
Yeah. Yeah, kind of a gift from relatives, things like that. But check this out. The total payment, $1,464. And now I'm going to give you the breakdown. Pay close attention. Principal and interest, $533. Taxes, $541. So our property taxes on this place, that's if the property taxes were $6,500, okay?
That's the cost of walking in the door.
Right, even if you paid cash. You're going to have that kind of a property tax. So the property tax was more than the principal and interest, then $40 for homeowners insurance, and then, well, what if the homeowners association dues were $350? Totally possible on a condo.
$1,000 a month just to.
Yeah,
wow.
900 and yeah. So that was an eye opener.
But Dad, condo living is less expensive.
Well, I mean, it just, as we said earlier in the show, it just puts out there like a car lease. This is kind of the equivalent. When you get a car lease, the depreciation in the vehicle is baked into the payment. Mm-hmm. If you borrow the money, it's not. It's the realization of saying, hey, it's going to cost $3,600 a year to maintain your portion of the ownership of this whole big building that you're buying into. Yeah. So we're just monetizing that. That's the word I was looking for, and putting in terms of the monthly payment. So then, interestingly, it's like, hey, you know what? You can, if you bought a $250,000 property and borrowed a little more at $130,000, that comes out to the same payment if the taxes are less at $6,000 and the association dues are less at $300,000. So when you're looking at a condo, I think the takeaway here is a lot of the monthly affordability has to do with property taxes and the homeowners association. Sometimes it can be as much or more than the principal.
Did you talk at all around, boy, that's a really big down payment? And I just know that when I'm talking with home buyers, and sometimes we're talking the difference between 5 and 10 and 20% down, the difference in the payment doesn't move the needle as much as, yes, I would like to keep several tens of thousands of dollars in my pocket.
They were really trying to get to an affordable payment in her case.
I get that because, if you got to make a payment where you can, or a down payment so you can sleep at night.
That's right. So that was the case here. Because, again, single person, single income, that's a big part of it. Okay, so then I got another nice email. Oh, actually, it was a survey. We do a post-closing survey of everybody whose loan we closed. And this person was really complimentary and said, thank you so much, because in their particular case, what had happened was the appraisal came in lower than their purchase price. They were going to put 20% down. Mm-hmm. The appraisal came in lower by $10,000. The seller was kind of, hands on their hips, like, well, that's baloney, our house is still worth it. And, by the way, the roof was kind of getting towards the end of its life. And so what we were able to do is help them negotiate the price down a little bit, not the whole amount that the appraisal came in short. But the key was I then proposed, why don't you put 10% down on the Equity Builder 20-year fixed.
There you go.
With no PMI, no monthly PMI, okay, because the cost of the Magic PMI is cheaper, a lot cheaper on a 20-year fixed. So anyway, they ended up closing with 10% down, which allowed them to keep like $39,000 extra in their checking account so that they'd have money for not only the roof, but to do a remodel. They were just thrilled with that, kind of, let's call it creative problem solving.
Well, I get that question. I did this week at least twice. Hey, I know that the garage is going to need to be fixed, right after I move in. Can I finance that into the mortgage? Mm-hmm. And the answer in 2017 is no, we can't lend more than the property is worth at the time that you're purchasing
Unless you do an FHA 203K loan, which we don't do and is really, really expensive.
No, but the way to get there is
less down.
Exactly.
So you're financing it yourself by putting less, money down, which is super duper smart. Okay. So the kind of wrap up takeaways from this week's show are Janet Yellen's on the warpath with the Open Market Committee of the Fed to raise rates. She's threatening to do it in March. Right now, the market doesn't believe her. But,
they got to get started sometime. Especially
if they're going to do 3. Economic news is good. Inflation numbers this last week were stronger than expected. So that means if you got a home equity line of credit, your rate's going to go up again. It just went up in December.
Or if you have an ARM coming due as well.
Not too many people with ARMs left. But a home equity line of credit is an ARM. Okay. It's adjustable every month.
Yeah.
Right. So now is a great time to combine that with your first mortgage, maybe get on the 20-year fix, maybe the 15-year fix. And, of course, home buying season is really revved up, and we are excited. We are issuing lots and lots of our rock-solid, guaranteed, fully verified pre-approvals, and a lot of our buyers are getting accepted offers, and they're winning because the inventory is still tight out there. So we'd love to help you or a loved one with a rock-solid pre-approval to buy and put you in that winner's circle. All right, that's all the time we got back. We'll see you here same time next week, Steve. Thanks.
You got it. Straight ahead, Colleen Bolin joins us from the WTMJ 24-hour newsroom.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.